All right, I think we are ready to get started. So thank you everyone for joining. I'm Kevin McPartland, Head of Market Structure and Technology Research here at Coalition Greenwich. We are a global benchmarking and analytics firm focused on the capital markets. I'm very excited for our conversation today about the growing demand for private credit and the evolution of that market. Before we get to the conversation, just a few very short administrative points. Questions are definitely welcome, so please use the Q&A box to enter those questions, and I will do my best to inject those into the conversation today. If you have any questions after the webinar, we will provide contact info for everybody, so if you'd like to send those questions directly to the panelists, you will be able to do that. For any journalists that might be on, if you'd like to quote anyone directly, if you could please connect with the panelists directly after the fact, to confirm, we would all appreciate that. And lastly, we are recording this webinar, so we will send the recording and a brief summary of the conversation to everybody who has attended and registered. So keep an eye out for that. And with that, let's get into the good stuff. So first, if the panelists could do a quick introduction of themselves, that would be great. Brian, why don't we start with you?
Thanks a lot, Kevin. Happy to be here. I'm Brian Pham. I'm the head of institutional sales at Percent. We're a private credit platform working directly with high net worth individuals, RIAs, family offices, and interval funds to provide direct access to private credit. Anyone searching for high yielding monthly current income and uncorrelated returns. Started my career at JP Morgan working with ultra high net worth individuals, helping them with their wealth management and asset allocation. And ever since then, I've been sourcing deals, raising capital, and doing diligence in the private credit and alternative space. Thanks a lot, Kevin.
Yeah, thanks for being here. Aaron, why don't we go to you?
Sure. Hey all. Aaron Rosen, I've spent the last 20 plus years in the finance industry with a particular focus in illiquid alternatives. I'm the portfolio manager for AOG Institutional Fund now, which is it's an interval fund, broad asset allocation across alternatives, illiquid alts, with the basic goal of providing endowment style approach to investing, bringing institutional investment access and opportunity in terms to non-institutional investors.
Awesome. Thanks, Aaron. Paul, why don't we go to you?
Great. Thanks a lot, Kevin. Paul Gaffari, glad to be here. Like Aaron, I've been in the asset management business for 20, 25 years, came out of the hedge fund world, and then I ran a large family office for a number of years. And I have recently co-founded the firm Pursuit Funds. We are going to focus on private credit and very specifically within the broad private credit universe, niche or specialized finance assets, with a focus to try to bring these assets to the mass affluent RIA market.
That's awesome. Last but certainly not least, Steve.
Hey, thanks, Kevin. My name is Steve Larson. I'm a CPA and a certified financial planner. Own a mid-size RIA here in the Pacific Northwest, and we kind of serve the mass affluent and some high net worth. And I've done a lot of alternative investments over the last decade, so just trying to figure out how to best implement those for our clients.
Fantastic. Great. I love this panel. Everybody's in sort of alts and private credit, but from all different perspectives. So it'll be a great conversation, obviously a bit by design. So with that, let's get into it. So 2023, of course, was quite a year for private credit, effectively became sort of mainstream news in the financial markets. So to get us started today, I'd love to hear what you're all thinking, hearing, seeing as we're heading into 2024. Aaron, you're sort of multi-asset, so maybe start us off with what are you thinking about sort of private credit, and then how does that relate to all the sort of the other alts and other assets that you might include in your portfolio? How are you thinking about those allocations?
Yeah. So we are overweight, a significant overweight in private credit. And you're right, we have a very broad mandate. If it's alternatives or uncorrelated stocks and bonds, we can pay attention. So it's an extraordinarily wide moat for us. I think our fund today stands at right around 50-ish% private credit, which is a very significant overweight for us. It was reversed. I think we were 10, even a year and a half ago or so, we were probably 10 or 15%. So we've been dramatically decreasing some kind of earlier, longer standing vintage PE, for newer PE, moving a lot of our real estate equity into real estate debt. And just generally speaking, look, we don't make a decision from like a macro view. Hey, we want private credit, so we're going to overweight and then just start paying attention to those. It's actually the opposite. It's very much fundamentally bottoms up. We pay attention to every opportunity. Sure, there's some macro guidance to give us perspective. But the deals that we're doing, the opportunities we're investing in, are very much a factor of what they are relative to other opportunities across the entire spectrum of investing. So it's individually a DD process. So what we've been finding is that we can continue to source private debt and credit opportunities at equity-like returns, or even better. We've been finding some of the best private credit ops I've found in my entire career, to be perfectly frank. We're in an environment that has rewarded those with dry powder and the ability to kind of move around within a stack. And so we've been really excited about what we're sourcing there, and we're being very opportunistic in doing so. But like I said, there's reason to have some varying level of concern about equity values in a number of spaces. Being able to move to a senior part of the stack, but not lose out on IRR potential. It's very attractive. It's very useful as a PM for me.
Such a good risk return ratio there, it sounds like, for private credit. Like, is it too good to be true? Like, I'm sure you've thought through all of these things, right?
Yeah, some, and the answer is some is and some isn't. We've looked at all kinds, and we've walked away from no shortage of deals, right? Most deals and opportunities we walk away from. And we found plenty that were just completely mispriced, that if you really dig in, there's significant concerns that are under the surface, things you have to worry about. So I think, like most things, it's so vital to be able to cherry pick the right opportunities. So I guess to say is, in the bubble of saying when you're focusing on the right opportunities, no, those have felt very attractive. And whether they on a real estate side become, loan to own at LTVs below 60%, or there's substantial asset backing and over collateralization from a kind of corporate or company side, right? These things start to make us feel more comfortable, and we're able to guide terms right now. We're often where founders of companies are pledging their own individual capital. There's a significant enough equity book in front of it that it creates a really attractive kind of first loss out as a buffer for us. So look, you can't predict the future. What I'll say is, like I said, from an underwriting perspective, the terms and collateral and everything that's going into it is been remarkably attractive.
That's great. That's great. Yeah, like all investments, understand what you're getting into. And we're going to talk about transparency in this market in a bit. So Steve, you're coming at this from an RIA perspective. What are your clients asking for? Are you talking about this segment more? And like, how has that conversation evolved?
Yeah, I think once we introduce them to private credit, a lot of times it is this too good to be true? And that's something that we have to wrestle with as well, because these are equity-like returns. And if we can get the diversification quite simply right without overwhelming the client, then it's something we have to look at for a good chunk of their portfolio. So very unsurprisingly, they are nervous about the equity markets. They are a lot of uncertainty with the obvious things in the election that everybody's talking about. And so they are still looking for real estate, even though they're a little bit scared about that. And private credit has really been the most intriguing by far. So from a RIA standpoint, it's how much of that is going to be considered an alternative, because we've got some compliance restrictions on what we can do, and how much of it is just fixed income. How much of it can we replace a fixed income portfolio with this private credit? And so a lot of that comes down to liquidity and the tool you're using. So there's some kind of logistical considerations from our standpoint, but as far as what the clients are talking about and like to see, they're not necessarily bringing that idea to us like they do with some other things they hear about. I wouldn't say private credits hit kind of the mainstream CNBC crowd, but once we introduce it to them, they're very interested, and they're kind of start to ask questions about, okay, how much would be reasonable here? Can we maybe up that a little bit?
Well, so your point about fixed income versus alternatives, it's actually a question we asked about in the research we did in the fall, which I'm going to post a link to in the box for everybody to take a look at. How do you think about that? Because it's effectively both. So like, where does it go? And is it a client by client, or how do you think about that as an advisor?
That's a great question. So it is a little bit client by client. A lot of it is what we're replacing. So when we bring a new client on board, it's a little different. It's more just kind of following our straight up compliance guidelines we set out. But if it's an existing client, we're usually replacing something. So we have to be very aware, are we just swapping out, Blackstone for a better solution we found, well, then it's like, okay, then it's a one-to-one swap of whatever we had it before. But a lot of times we really do want to replace a bond allocation in a bond position and do it. And so if we have a good conversation with the client and they understand that the liquidity is a little different and the risk is a little higher, at least in theory, then at that point we can consider it fixed income and move forward. But it is tricky. I don't think there's an easy answer to it.
Yeah, thanks. That's fascinating. So Paul, you're in product development mode. You've been in this market for a long time. How have you seen things evolve, and what are you thinking about? Like, what's driving your sort of product, fund development right now?
Sure. So, if you think back 15 or 20 years, I mean, it's sort of night and day what's happened in the private credit markets. Private credit has grown. We ran some data about 30 times in the past 25 or so years. The sort of TAM, the market. If you think about where that stands versus all of fixed income, I think the U.S. fixed income market is something a little over, we're talking about just the domestic market, something a little over $50 trillion. Today, private credit is still a fraction of that. It's maybe 3 or 4% of that. So, there is a bit of a gold rush atmosphere in private credit right now, a lot of players coming in. But if you step back and look at in the grand scheme of all the assets out there, including equities, it's still a very small percentage. And then if you study what the participation is, whether it's institutional or family office or mass affluent, say in the RIA world, it's really a small portion. So our thesis is it's early days, and I kind of liken it. The analog would be going back to where private equity was starting in the the late 70s and 80s. It really began to explode with all the M&A activity and all the moves into out of beta or out of traditionals into alts beginning late 80s, 90s, and into the 2000s. I think we're 25 years behind that with private credit. So things that maybe 10 or 15 years ago that would have been considered niche, let's say litigation finance or receivables factoring, these actually are becoming quite mainstream. So at Pursuit, what we're doing is we're really trying to be out in front of what we now would consider mainstream strategies and get into things that are a little bit more specialized, whether they are asset backed or whether they're cash flow backed. What we really focus on are very high income from predictable cash flowing businesses, short duration assets to really differentiate ourselves from other alternatives. Low correlation, as Aaron and Steve mentioned, to the other markets. And if you run the R-squareds on a lot of our strategies, they really have almost negative and sometimes negative correlation. And we're looking in the mid to high teens now. 3 years ago, with a zero interest rate environment, we were happy to get 9, 10, 11%. We now can originate paper at SOFR plus 1,000, 1,200, 1,500, even more. So you should be able to, in a very disciplined credit regimen structure, get into the mid-teens. So I see that as the really exciting part of the next couple of years. Obviously, everything is subject to the economy and what the Fed's doing in rates. But this is, I don't want to say this is like the golden age for private credit. It's always a dangerous statement, but it is and I would echo what Aaron said. This is a very ripe environment for dedicated private credit players.
I love it. So Brian, so a few things from all of that I want to take to you. So you're sort of at Percent, you guys sort of sit in the middle and you make a marketplace and you kind of help get everybody connected, the buyer, the investors, the borrowers. Paul mentioned about how it's gone more mainstream. So I'd love your thoughts on why you think that is. Is it technology? Is it overregulated banks? Whatever the answer is. And then maybe also if you could step back and give us an overview of the landscape. sort of what is in the sort of what's in there. Like we know, like I think somebody mentioned Blackstone, like big. There's the big firms and there's smaller names. Like, can you talk us through like what the whole ecosystem looks like as well?
Yeah, absolutely. So, it's a huge ecosystem. It's constantly growing, as Paul mentioned. So you have the household names, the Blackstones, the Ares. They're raising $10+ billion funds at a time. And when you're raising those large institutional funds, you need to put a lot of money to work relatively quickly. So at Percent, we're focusing on lower middle market private credit. A lot of the loans we're making are sub $20 million. The underlying businesses and borrowers can be anywhere from 0 to 20-ish million dollars in EBITDA. And when you're focused on this niche part of the private credit market, there's not as much competition. And subsequently, you're able to get higher alpha and higher risk adjusted returns. Because we've done a lot of research over the past few years, and it's shown that leverage tends to be the main reason for these private credit deals to default. It has nothing to do with the size of the deal or the size of the borrower. So being able to, find these deals that are $5 to $20 million and providing mid to high teen yields when other big blue chip firms need to deploy $10 billion, they're now going to be doing $100+ million deals. And when you're doing deals of that size, you're now going against banks, and banks obviously charge a much lower rate. So now you have to compete with them. Now you're getting a lower return for the end investor. Now there's obviously a place for the blue chip names. You can view them as, maybe a little more conservative just because of the fact that no one got fired for picking Blackstone. But I think that, a lot of the panelists here, Aaron, Steve, Paul, they're finding the alpha from these emerging managers from firms like Percent that are able to add alpha to their portfolio without adding maybe necessarily the risk that others perceive. So being able to provide those uncorrelated returns, I think monthly current income, which a majority of our deals provide, is something that's very unique in the marketplace, where typically private credit funds might provide quarterly distributions. It also helps mitigate the J curve for a lot of these interval funds that are, investing across various asset classes. So some interval funds will invest in private equity, venture capital, real estate. And when you're investing in those asset classes, depending on how they're valued and marked, you can see the value of the interval fund dip at certain points. So being able to provide current income quickly, that's a value add. And providing income for clients is a very easy way to kind of lower their fears about the broader markets, right? Because you're seeing volatility across all these different markets, whether it's the interest rate environment affecting bond values or the equity markets, with various things going on in the geopolitical atmosphere, and some people saying, oh, it's overvalued, whatever it may be. Okay, now I could hang my hat on my private credit sleeve of my portfolio, whether that's 10% or 30%, like Steve was alluding to. How overweight are we going? If I'm in an endowment style investment approach like Aaron, I can go up to 50% or more. You're seeing that a lot too with tax efficient investors like foundations and endowments. They're saying, okay, this is taxed as ordinary income for an individual, but for myself, I can get it more tax efficient. For our investors, they can put it in self-directed IRAs as an example for tax efficiencies. So we're seeing just a lot more inbounds from RIAs and family offices that are looking for these solutions that their clients are asking for. And I would say the biggest hurdle, Kevin, is really operational. So what we're able to do is, one, being able to provide direct access to these private credit deals, provide the performance and target returns that they want, but more importantly, an operationally efficient solution. So whether that be working with firms that have an internal fund vehicle, whether it's a limited partnership or an interval fund, being able to plug our direct deals directly into those, or building a customized SPV on their behalf. Essentially, ABC Wealth Management Private Credit Fund, we launch it for them, we manage it for them, and at a cost of zero startup cost, zero operating operating costs, unlike a lot of other platforms, which will add access fees and operational expenses, which add up when you're already getting charged 2 and 20 from underlying general partners.
That access point is a really good one. And the title of our webinar, right? We said growing demand and access to private credit. Maybe this is a good one to take to Steve on that front. So what are the mechanics of getting those investments into your portfolio? Can most financial advisors, wealth managers put those investments into traditional accounts? Like, is it operationally complicated? Do all systems out there to manage, like the tech, can it handle those types of investments?
Yeah, yes and no to all of that. So it's really where the rubber meets the road, right? Because as a financial advisor, you have no shortage of offers in your email inbox to go look at different alternative funds and private credit. And at the end of the day, just to be honest, it's almost less about the fund and analyzing the manager as it is about what will work in your operations and what you can actually deliver to the client in an efficient manner. So interval funds are typically the easiest. Well, outside of just a straight ETF, obviously, but interval funds are typically the easiest. Outside of that, what we're seeing is most RIAs will use a platform to do this for them. So whether it's an iCapital or an Atlas that we're building an American Estate and Trust, or the Schwab One platform, because those will typically already integrate with a billing system, with a reporting system to get to the clients. So the funds that are kind of after the one-off RIAs always have an uphill battle to fight. Not that it can't be done. But really, from the perspective of a registered investment advisor, you're always asking 3 questions. How do I bill on it? How do I trade on it? How do I report on it? And so in this case, it's maybe less trading and more filling out subdocs. And so if there's questions from any of the attendees, I'm happy to dive into any one of those or each their own rabbit hole. But more to back up your point that it is very operationally focused as far as, hey, what can we actually roll out here that's not gonna make the client jump through all kinds of hoops.
Paul, Aaron, either of you want to sort of chime in on the access point?
No, I would really I really second the point about technology and how it's changing our market and how it's helping democratize private credit. And I think it's a phenomenal thing for Steve's clients and other RIAs, retail clients, but also for larger family offices. The things that somebody like Percent are doing using their technology engine to be able to originate these assets. If you think about how hard it would be for an individual, say, to originate an asset-backed deal, a single asset-backed loan, and virtually impossible. Brian and his partners can do that using a technology platform and generate tens of millions of dollars of paper, every single month. And things like interval funds that are highly regulated, obviously, are great things because that gives the client a lot of surety and protection that this isn't just the Wild West. And so I think these public vehicles, BDCs, interval funds, tender offers, are a much better way for individuals to access private credit versus private funds. And the reporting is obviously a game changer. If I can get my client a 1099 within 30 days after the end of the year versus waiting months and months for 25K ones, that's just a non-starter. So I think technology, fintech has completely changed the game, and that's why I think that this private credit market today at $1.5 trillion or so, I think it'll multiply many times over the next few years, and access is going to be becoming increasingly easier.
Look, as the manager of an interval fund, right? I'm not going to argue what Steve and Paul are saying here. I'll say this. Yeah, they really hit on some of the things that our investors have really found to be extremely valuable for them as part of what they go through and what things are made up for them. But speaking as a PM, I think the technology, I agree, it's really improved on efficiency and access. And then I'd mentioned it's transparency too, right? So everything in the end is about underwriting and understanding where your dollars are to work and what things are and the risk versus reward. And I think being able to utilize technology and kind of a shout out to Percent, Brian's group too, we do use them for a particular pocket of our overall portfolio. generally on the shorter term side. And they use their usage of tech, right, to simplify the transparency, allows us to act much quicker, right, than we had in the past. And being able to be more adept and move fast and adjust on the go has been tangibly beneficial to us overall.
And I think Aaron brings up a great point. When we're working with sophisticated investors like Aaron, and they might have relatively leaner investment teams than, let's say, the Blackstones and the Ares of the world, us being able to save them time is their most precious resource. So being able to get the transparent data, all the due diligence in a way that's easily digestible is something that we've found that our clients from RIAs, family offices, to interval funds across the board have really valued. Because at the end of the day, time is something that's limited for everyone. And so being able to focus on maybe other areas of their portfolio because they just saved hours of their day or week when analyzing the investment opportunities that Percent has already diligence for them. So that's the beauty too. We're not just a platform. We're looking at hundreds of deals and opportunities to invest in, and we're funneling that down to one deal. And that's the ability to streamline that process and make it widely available to not just the institutions like Aaron and Steve and Paul, but also the individuals, the doctors, the lawyers, these accredited investors that have not had access in the past to direct deals. That's very changing part of the environment across private credit.
And what about, so, and just, there's two great questions from the audience. So just, I want to let those folks know we're gonna get there, I promise. But so how does transparency improve? We talked a little bit about access. You guys touched on transparency briefly, but like for public markets, obviously, I suspect you have your data terminals, and that's sort of pretty easy to get. Sort of even bond prices today are infinitely easier than they were 5-10 years ago. So how does it work here in private credit? Like, what are your main data sources, and how do you think, what are your suggestions to the world, to the fintechs? Like, how could transparency into this market improve from a data perspective? And I'll sort of put that out to whoever wants to jump in.
Yeah, I'll start off with that. I would say for us, transparency is so crucial because essentially that's what we're trying to do. We're trying to bring the transparency of the public bond market to the private credit market. Because before you would make a loan to a private company or an asset-backed loan, whatever it may be, and say, okay, pay me back at this date, make these interest payments, and it's held at par until then because you say so. But with us, we're keeping weekly surveillance reports for our ABS deals, monthly surveillance reports for the corporate loans and venture debt that we're doing. So you can see the performance, not just, oh, did I get my monthly payment on time, but also, how close am I to comfort in terms of, are they going to be able to make the next monthly payment? And then also having the transparency on our side when we file UCCs on these underlying assets so they can't take out loans against the assets that they pledge to this ABS deal. Us having DACA control over the bank accounts. So in case the borrower breaks any of the covenants that we have to protect the investor, then we can take control of the bank accounts and go into what's called a rapid amortization to get back as much principal as possible. So having all the transparency leads to more protection for the end investor, as well as making it way easier for the due diligence process of anyone who's a professional investor to a retail investor, which is nice. And it's just more about knowing what to look for. So that's what we have in these comparisons tables, where it's like, these are the key metrics that professionals look at. So this is where you should start out at. And then the other people will then dive deeper into the data rooms that have all the different financials. And, we do operational due diligence here at Percent as well, do background checks, collateral verification checks. I mean, it's a checklist of dozens of different things that need to be done before we greenlight investment for the institutions as well as the retail investors.
That's great.
Yeah. The only thing I think, I mean, look, all of that was spot on. There's very little replacement for obtaining and diving through the underlying financials and ongoing financials of whoever it is you're lending to. I think that's probably something that is unfortunately overlooked far too frequently. It's like, oh, it'll to the point these guys are making, right? Oh, it'll pay this, it paid on time, right? Or, everything could be coming apart underneath the surface and you have no idea until it's too late. As a PM, the worst thing in the world that can be is too late, right? Things can happen. There can be problems in something. So long as I'm early enough to deal with it, we're going to be fine, right? Being the last one to know or late to know, that's when you really get stuck, and that's where pain really tends to occur. So you talked about, what else tech could do. I'll say one thing that I have noticed, right? We can have all this transparency, but most tech has its own fundamental language, and whether that be via metrics or terms or what they measure or how they measure it. Increased consistency across multiple platforms for terms, language, etc., right? That fundamentally is going to help further democratize this landscape.
Yeah. Standard reporting, just like we have in the public markets for equities, for bonds, goes a long way. Absolutely. That's probably a good segue into one of the audience questions. So thinking about is it too good to be true in managing risk? So the attendee pointed out, we've talked about diversification, over collateralization, asset-backed loans, and then conservative underwriting due diligence. Any other strategies that you think about as the investor from a risk management perspective, whether it's for you or then Steve for your clients? Like, how do you think about that? Any other suggestions there?
Yeah, one
How
that
much
might
time
be
do we have?
Yeah.
Yeah. One that might be a little, not unique to us, but maybe more of an emphasis would be the liquidity. And so both within the fund, obviously, we've got to make sure that there's money ready for redemptions at any given time, but also that also has to be coordinated with the client's financial plan. So if it's money that we need for a distribution anytime soon, right, it's got to be in a vehicle that's extremely liquid or that we can get at right away. And that can also drive a lot of the allocation. So the only thing I'd add is liquidity, and for us, there's kind of two different fronts. It's how are things stacked within whatever vehicle we're using, and then what does the client's plan call for as well.
Right.
Yeah.
If it's money you're going to need in 6 months, then maybe not. Right.
Yeah.
Kevin, I just add a couple of other things. What's really interesting about, I think of this as a silver lining of our market, where we're looking at much more inefficient businesses, not inefficient business, inefficient parts of the market, smaller markets, doing loans, say from 3 to 7 to 10 to 12, 15, maybe 20 million. When you're a Blackstone or an Ares or a Golub or one of these guys, and you're in comp to bid on a $500 million facility, you rarely are going to be able to include covenants, because you got to win the deal. So structuring the credit correctly, covenanting the credit directly is actually something that we do in the LMM markets, in the small business markets, obviously in the consumer markets. So in addition to collateral, in addition to amortizing loans that pay down fast, and you have that liquidity, as Steve mentioned, I think structural seniority is very important, and documenting covenanting the loan is a big part of our underwriting process. To mitigate
Yeah,
this.
I want to echo that for a second, right? Again, it's one of the harder things to simplify and make transparent and kind of put into a box is covenants, right? Terms around the loans, and so much of the important minutia revolves around the covenants. The covenants are what make or break you in times of kind of in more significant upside or downside, certainly in distress, right? Those covenants set the right way and set specifically are completely, they're massive differentiators in the resulting performance of, various private credit. So it's almost hard to understate just how important it is. And I think probably something else that's overlooked. Steve was kind of tagging on liquidity too. I agree. Look, as a PM, I want to tier my vintages and tier liquidity the same way we tier vintages, right? So we tier liquidity, especially on the private credit side, the same way, thinking about making sure that we have capital coming back to us, staggered across, not just a cycle, but any really period of time, because, I'll say the single most valuable thing you can have as an active investor and with active management is dry powder when you need it. You're not going to time markets, right? Generally speaking, it's a fool's game. but being able to have dry powder when it's the right opportunity, being able to find the right entry points, extraordinarily valuable.
So I feel like I should have brought this up in the beginning, and it allows me to ask one of the other audience questions, but thinking about public versus private fixed income, and sort of how do you decide? And obviously the bond markets have been on their own roller coaster ride over the last few years, which has brought a tremendous amount of money back in now that you can even get 5% from the government risk-free. That's not terrible. It's not 15, but it's not bad. So sort of what does that landscape look like? And the question from the audience was, that when we've talked about private credit, all of you, we've talked about a host of things, right? So trade receivables, direct loans, asset-backed lending. What's in the bucket? Like, where is the line where it counts as private credit? I've heard people talk about even leverage lending as private credit, but that comes from a bank. So maybe like, how do you think about the lines there? And then also just the public, should I just buy high yield bonds versus private credit? How do you think about all of that?
I mean, well, the last question first, right? It depends who the audience is, right? It depends who it is that's investing, right? If you're an individual investor doing your own thing without any, professional expertise or managers or anything like that, then you should probably be sticking to public markets, right? And using broad fixed income and bond exposure, because you will have the ability to remove yourself from a situation in a single day. And you're not locking your capital up in a way where after the fact, when you find something out, you'll be punished the same way. And generally speaking, you'll be able to take less total number of bets versus say a diversified portfolio. So yeah, it's so audience specific on that. Look, from my perspective, we look at it as kind of a model of efficiency, right? Public markets and bond markets in particular are quite efficient. They're very efficient. So we'll look at them as kind of a leading indicator of sorts for data information and kind of pattern recognition, if you will, when we're involving the tech. But really looking forward as a forward indicator of how people are reacting to things, what's being priced in, how prices are moving, yields, flows, etc. And so it becomes relevant for us as we then take a step back and say, look, we're looking at private credit. We should be obtaining significant illiquidity premium versus something that you could trade every day. And how is that being done, right? What is the inefficiency of the market or niche or environment that they're in? How does that translate over? And then how does that compare to public alternatives? Because the reality is, if we're not getting a significantly better return potential from something in the private credit side, then barring that, you should be in the public side. I mean, you're doing yourself a disservice to lock your capital up for no reason.
Yeah, I would just also add in response to that last question, what's in the bucket? Well, this is like a living organism. Private credit is constantly expanding, and stuff is moving from niche or specialty finance over into maybe more mainstream. I mean, cannabis lending today, I guess some people would say is quite mainstream. Certainly something like litigation finances. But every time that we uncover a new strategy out on the spectrum of specialized or niche, then it enters into the broad private credit bucket. And I think that as banks and other regulated lenders continue to exit from the space, more and more of these specialized strategies will come in that banks simply are not going to be able to touch because of heavy regulation, which is not going away.
So that's actually a good segue. We're running short on time. We probably have about 5 minutes, but I found it really interesting to watch over the last year how private credit, which is by definition is lending from non-banks, how the largest banks in the world have sort of moved themselves into private credit, which almost feels like an oxymoron. Investing in private credit funds or finding other ways to get involved because the segment is hot. I'd love your thoughts on that. Is it ironic to you? Is it good? Is it bad? Is it effectively just additional capital that'll help the market grow? Like, how should we think about their involvement?
Well, that's an interesting question. It can have a dual effect, certainly, right? I mean, more capital innately chasing after the same arenas, sectors, right, is going to inherently water down the return potential. Right. So you want to be, in theory, identify and operate in the most inefficient landscape that you can when you're trying to target alpha generation. So the more money that comes in, the more competition there is for the same type of deals and opportunities. The end investor inherently will be finding themselves with a lower return stream. So I think it's probably important, at least with the way we look at it, is we tend to prefer our niches that aren't massive, right? We don't want to, oh, it's a $2 trillion niche. Like, no, it's not. That's not a niche, right? And inevitably people will come. So we look for true competitive advantage, and everyone will say they have one, and very few actually do. But when trying to differentiate from those big banks, because big banks in the end can't take certain, I'll rephrase, it's very, very difficult for them to take certain risks going after smaller niche arenas, smaller managers and opportunities, because it just doesn't move the meter for them. Or it's so unique that they can't get comfortable from a broad generic underwriting standpoint. And so I think that differentiation will continue to be there, right? And some things will flow one way and some will flow the other in regards to that. But I'm not sure I would take it for much more than that. Look, the bigger the company, the bigger the bank, insurance companies, Diamond's right, they get stuck in some boxes, I think. And one of the significant advantages of being, a smaller fund manager, firm, right, is being able to operate a little bit outside of those boxes, and identify and create alpha through that.
And I think at a big picture, banks going more into private credit the way they have kind of emphasizes the investment thesis that all of us have, right? Private credit is here to stay. It's not, just in vogue now because of the interest rate environment, or because venture and private equity and real estate might be a little harder to invest in at this current time in the environment. But it shows that, private credit is going to be forever in people's asset allocation. It's just a matter of how much. And I think that all the panelists here can probably agree too, is, there's going to be more alpha in the lower middle markets, because even the banks, again, as I mentioned, the blue chip firms, they have so much capital to deploy that they need to deploy it in those big 100, 500 plus $1 million deals. And they're bidding at them against other blue chips and other banks. So now the rate of return that they're getting for a private credit deal is only, maybe 100 to 400 basis points more than a bank loan might be able to provide. And it's just unbankable, but now they're paying a relatively smaller premium. What does that mean? A lower net return for the end investor. So I think if you're going into these, lower middle market or niche private credit deals, you're going to find the alpha that you're looking for, the differentiated returns, while achieving, uncorrelated returns to the broader public markets. And if you can get it with shorter term duration, like what we're doing at Percent with, 9 to 36 month terms, on average about, 14 to 18 months, that's, it allows you to ladder out your portfolio, whether you have an internal LP structure like Steve's firm or an interval fund structure, again, providing the liquidity needs for various clients, no matter what the size.
That's great. And so we're just about out of time, but there are two questions on the same topic that came in, Brian, I think probably are perfect for you. Two questions about the secondary market. So is there a secondary market? How does it work? And will it grow over time?
Yeah, I mean, there is a secondary market for private credit and also all the other alternative asset classes, because, bringing up our earlier point, people need or want liquidity. So sometimes they're a forced seller, so they need to take it at a discount. We're exploring ways to make it more efficient for our investors to get, be able to have secondary sales. And it's a unique opportunity, because then we're also on the flip side having our investors that want to buy the secondaries, right? Okay, I could buy it at a 1 to 10% discount or whatever that discount is, and be able to get to what Aaron said, an earlier vintage. So maybe it's not even at a discount, it's at par value, but now that vintage was at 20% when the current market rate is at 17, as an example. So definitely a huge secondary market. Last time I caught up with Paul, they were, he loved that market when in his prior life as a family office and sees the value in it. So Paul, feel free to jump in here.
Well, I think the answer is technology. Again, that's going to change everything. It's going to be 5 years from now, we're going to have I suspect We're going to have platforms that trade these kind of credits the same way that platforms have emerged over the last 10 years in the PE, in the private equity world. It's never going to be as liquid a traded market as in the public markets, but it will evolve, and I think you'll see a bunch of competitors jumping in, which is going to be a good thing for bringing clients into the market for that very reason Brian mentioned, is you have some backdoor liquidity if needed.
Yeah, we absolutely love using secondary markets and especially buying on them. Made a lot of the reasons that Brian and Paul just mentioned and others too, but it's such a useful tool to be able to, like you said, diversify across vintage and an opportunity set in specific terms. And again, we've talked about, alpha generation through inefficiency. Inherently, there is a little more inefficiency on secondary markets, and generally sellers tend to have a reason why they're selling that is beyond, that oftentimes is beyond just, oh, we don't like this anymore. It has to do with them needing to create liquidity for their LPs or having some other cash need or whatever it is. And by being kind of quick in those environments, you can take advantage and find and directly add alpha generation versus a primary market opportunity that could be very comparable.
I was going to let that take us out, but there's another, I can't leave it on the table. Steve, this will be a great one for you, and then we'll let that take us out because it's a perfect question to end. What are things to consider when looking at private credit for end clients, things to avoid? Like what's your whole thought process in client conversation?
Yeah, I have a couple of thoughts. So first, I think you can kind of tie together a lot of what we're talking about. We're obviously after alpha, but the other thing we're after is diversification, mostly non-correlation. So I agree that these secondary markets are coming, but we don't want them to become too efficient. If our private credit is getting revalued every day, right, we haven't accomplished a whole lot with the non-correlation, right? It's like non-traded REITs versus public REITs. You do a public REIT, I'm not sure what you're accomplishing because it just moves along with the equity, at least from a asset allocation standpoint, right? So we don't want to get in that same position with private credit. We kind of like that there's that they're not repriced very often. It adds stability to the portfolio, and as long as you have that transparency, great. So as far as like what to look for and what to avoid as like an advisor, one of the reasons we moved towards our own fund and on the Percent platform is because Blackstone and the big ones were just feeling like a black box. It's like managing equities, just off the 10K or something. It's just we're getting everything after the fact and didn't feel like we had a lot of influence there over how to exactly manage these portfolios and avoid any troubles that might come. So we like the small market and specifically Percent. I'll give Brian a plug while he's on here, just because of the transparency, because we can get out ahead of it and know what's happening and feel like we have a little bit more control. So the things the advisors already know, like diversification, low cost, et cetera. But I would say as we really started to ramp it up, the transparency became really important so we could stay ahead of our client communication on it.
All right. Awesome. Yeah. And with that, guys, that was fantastic. Super interesting. I learned a lot. I'm sure everybody listening learned a lot. So to the audience, thanks for taking the time. Like I said, we will send out a recording, a brief write-up. The questions we missed, I apologize, but we'll circulate those with the panelists and hopefully we can get back to you after the fact. So yeah, thanks everybody for joining us. Thanks guys, and have a good rest of your day.
Thank you, Kevin.
Thank you.
All right. Thanks all.